Hey guys, today we're going to be discussing oil well investment. So if you've ever been interested in investing in oil and gas, we're going to be discussing a prospectus, an oil and gas deal in New York. And today we have with us a former advanced senior geologist at Marathon Oil Corporation and a former senior staff geologist at Hunt Oil Company. And if you've never heard of those companies, they're multi-billion-dollar companies, and they don't just hire anybody on. And so, Kevin, say hello.
Hi, Sean. I'm Kevin Fowler, and I am the consulting geologist and originator of this project that we're going to be looking at today.
Okay, good deal. And so bottom line, Kevin's going to talk about the basics of an oil and gas prospectus. How does a geologist decide on an oil and gas deal and why we're drilling out here? So Kevin, go ahead. Let's start in this. Let's jump in. Here we are on page one.
Okay. If you go down to the next page, actually page two, because we're looking at the cover right now.
So this is called the West Union Oil Project. This is a 50 well conventional field development, Steuben County, New York. All right.
That's correct. Now, we call it a conventional oil project because this is not one of those deep shale wells that goes horizontal and has a mega frac. These are traditional oil and gas wells for the area, as they've been drilled out here since actually the 19th century, with the modification that we're drilling the wells deeper, we're fracking them better, and we're producing them in a modern way. So although we're surrounded by producing oil and gas wells, some of which are 50 or 60 years old, our wells will exploit the pay zones better, will reach down for more of them, and we will produce them judiciously to where they will have productive lives in excess of 20 years apiece. It's a 50 well project. The wells will be about 1,900 feet deep, but we will find pay sands everywhere from 700 feet to 1,800 feet within each well, up to 7 different formations in each well. Traditionally, in this area, operators have drilled down to the first 1 or 2 formations and have produced from those alone. This was economical for them, but they did not exploit the additional 5 pay zones that were only within 1,000 feet below them. They did not do that because it was cheaper to go for the first 1 or 2 and start producing them, but they still made money at it. New York, people don't really think of it as being an oil producing area, but wells have been drilled out here since the 19th century. What New York is discouraging and what they are encouraging are interesting. They're discouraging deep shale wells because they don't want the large dynamic fracs that could pollute groundwater and affect literally thousands of feet laterally underground. What they are allowing is vertical wells that produce from around the borehole, around the well itself, and are utilize only very small fracs to begin production. So these are in many ways very traditional oil wells with a modification of a light frac to make them more productive. Vertical Energy, the company that's going to be operating these wells, has done over 1,500 wells in Pennsylvania and New York. They have their own drilling and frac rigs, their own dozers, their own road building crews. So we are very streamlined in our contractor availability and in the experience of our crews.
I want to hit on that real quick. So Vertical Energy has their own rigs. They have their own bulldozers. They have their own equipment, correct?
Yes, that's correct.
And that's so key because you have your, most operators don't have their own rigs, okay? They don't have their own equipment. And so they're at the mercy of a rig schedule. And so if they're on a different part of the planet and they're waiting for a rig to show up, they might be sitting there for 3 months to get their well drilled. And then after they drill the well, the workover rig just to complete the well, they might wait another 3 months. And so we're not in a situation where we're waiting on someone else. So things get done much faster. And also it's we get it done cheaper because he's not paying the day rate of a rig sitting on location. That's his rig. And so they're able to drill each well for $165,000, which is at industry costs from what I've seen. I mean, it's in all honesty, I mean, it's cheaper than what I normally see when people send me out a prospectus. Okay. And so these are conventional wells. Shale is very expensive. It's a tighter formation. You're spending $5 to $10 million on a massive frac. Okay. And so these are conventional wells, and New York is not allowing these big shale guys, because they limited the fracking to 300,000 barrels of fluid. And so we can drill a well and hit all 7 zones and only use 200,000 barrels of fluid. And so we were able to pick up the lease quite simply because all the big boys are out of here. Okay. So go ahead, and Kevin, we'll continue.
Okay. A lot of the information in this report was drawn from Arthur Van Tyne, who is a nationally known geologist. He was a state geologist for New York. He was secretary and member of the AAPG, as stated up here in his mini bio, and he was local to this area. His son-in-law is Steve Ford of Vertical Energy. Mr. Van Tyne customized and recommended this lease to his son-in-law to drill. Mr. Van Tyne passed away last year, but he wrote a very favorable report to endorse drilling and completing on this property. Can we go to the next page, please, Sean? Okay, to summarize the advantages of this oil and gas project, high probability of favorable oil and gas production, less than 1% dry hole rate. I have never drilled a well out here that did not have oil and gas sands present. And out of the 300 wells I dealt with, only 2 were abandoned after drilling because of mechanical issues only. The oil and gas is here, it's producible. And I consider this more of a resource harvest than a chancy project. We will produce from 6 or 7 pay formations in each well, although historically operators have made money from producing only the top 2 zones in the area. We're going to go a little bit deeper, and we're going to triple the amount of pay formation that we take oil and gas from. We are located next to a state highway. We're close to gas pipelines, and we are easily accessible to refiners to pick up oil from the project.
And I want to key in here, Kevin, forgive me for interrupting you here, sure. But he said a couple things that when I look at an oil deal, and I made my first oil investment in 1994, and there are specific things that I look for. Number one, less than 1% dry hole ratio. That is uncommon. Okay. If you drill a wildcat, you got a 50-50 shot. You're rolling the dice here. Out here, less than 1%. It's amazing for hedge funds. It's amazing for big money that doesn't want to have a tremendous amount of risk. Number 2, he mentioned the infrastructure is already in place. So a lot of times you go out and you drill a well, and then you got to spend money on infrastructure. And infrastructure might take a year, 2 years, okay, before you even get it out there. And sometimes you negotiate with the property owners, and then turns out you can't even get infrastructure out there to sell the gas. And so that's what's called stranded natural gas. And then you have this big flare and you're wasting it. So from what I understand, Kevin, we're not wasting any gas, and we're able to sell the oil immediately. That's correct.
Oil used to be the only way to make money out here because there were no gas pipelines available. But since the 70s and 80s, with National Fuel Gas, the major utility for the Northeast, there has been a great web of gas pipelines built in the area that we can put the production right into. So we're going to be making additional money, essentially increasing each barrel of oil in value by about $15 because of how much gas we can produce from the project as well.
Excellent.
Now, this is, like I mentioned, this is a true cookie cutter project. We will usually be able to drill anywhere from 5 to 8 wells per month. And once we start a well, from the time we spud the bit until the time we have first oil is about a week per each well. We have well spacing that has been arranged already on a plat so that we're drilling on 5-acre spacing, a very efficient and very localized way to tie in oil and gas wells together and save money on pipelines and production facilities. We have multiple oil purchasers, all of whom pay the top West Texas Intermediate price. And we could even sell to more than one purchaser if we want to. The gas, as I mentioned, will be purchased by National Fuel Gas at New York mercantile prices, which is currently about $4.50 an MCF. Condensate and gas liquids can be separated as liquids from this very rich gas and sold separately as condensate. Individual well payout at $100 a barrel is about 15 months for the first return on investment. Second return on investment is at about 3 years. And we're not considering or including tax advantages in these return projections. We're simply stating dollar on dollar return on oil and gas sold versus money invested. Tax considerations.
Let me tap into that. So bottom line, he's saying that the returns, so you mentioned 100% of your money back in 15 months.
Yes.
And that's based upon cash on cash, and it has nothing to do. He's not incorporating the tax benefits. The tax benefits, you get to write it off 100% against your earned income, no different than giving it to a church or a charity. Okay. So this is tax deductible, win, lose, or draw, even if you drill the best well in the field. Okay. And so what, Kevin, how long would it take to get a return if oil prices drop down to the 80s?
If oil prices drop down to $85, for instance, you just take 15%, the difference between $100 oil and $85 oil, and you'll have a 15% longer payout. So you're going from 15 to approximately 18-month payout.
Okay,
now,
so just
gas
adds
price,
an additional 3 months.
That's right, but gas prices are staying quite steady. So even if we have a decline in oil prices, gas prices are still incessant. The gas flow will always be happening, and you'll always have that to offset your payout as well.
Yeah. And something I want to hit on. So there are wildcat wells out there. There are higher risk wells out there that have promised big upside. Okay. But the thing the biggest thing about this is the reason why veteran oil and gas guys like this. And the reason why this is favorable to us is quite simply, this is a resource play. Okay. This is not a get rich quick type of deal. This is something that could potentially return for the next 40 years. And it creates a revenue stream. It's safe in comparison to all the other oil and gas deals out there. Go ahead.
It is. Now, just as an aside to that, I've been drilling wells in this area or involved since 1989, and I'm still receiving royalties from wells we drilled in the early 90s. And those come monthly, both gas and oil.
And I've seen the checks. So those checks, the oil revenue checks, excite me more than any. You could say whatever you want, but you show me an oil revenue check from a field that we're going to be focusing in. That excites me. So here we are. All right. So what are we looking at next?
Scoot on down, if you would, to the bottom half of the page. These first few pages really set the tone for the whole project. As I had mentioned, wells have been drilled out here since 1883, and they discovered it was hard to drill down to 700 or 800 feet in 1883. They used old cable tool rigs, and they literally hammered their way down. So they stopped as soon as they found they could make money in a producing zone. So all the wells from the 19th century up until about 1980 out here were producing from only two sands that were shallower than 1,000 feet. And those were the Penny Sand and the Fulmer Valley Sand. These are both sandstone formations. And those have and still do make money for those who drill only those two sands. Now, we are going to exploit sands that have only been drilled occasionally since the 1940s, because the wells are a bit more expensive, but we literally triple our producible oil and gas if we hit these other sands below these traditional two. So that's what we're going to be doing with this project. Okay, we are looking at the history of the immediate area here next, where all these yellow highlights are. Now, if we could go ahead and look at page 7 for a minute, Sean, then we'll flip right back here. Just pull down to our large regional map. Now you see the West Union Oil Project lease, 235 acres in size. And to the west of it, up to the upper left of it, is a river that passes through the area, and the state highway is bounded by that river valley. Just across from there, you'll see several hundred wells. Just to the northeast of the project, you'll see a couple of hundred more wells. As you drop right below that, you see a new project just above where it says Edwards ONG, up there to the top right, up.
Right here.
To there, that small field right there is a new project that is being developed just northeast of our lease. And down to the south of us, where it says East Resources Crider Creek, is a past project that produced oil and gas from some of these deeper zones that we're going to be exploiting. Now, people say, why are they so frequently drilling on the north side of the river rather than the south? Well, it's a comparison of terrain mostly. If you look at the wells, the concentrated area of wells, it is mostly flat terrain or very gently rolling terrain, well served by roads. If you look to the right of the river, you'll see steeper terrain, and you'll see a lower abundance of roads because of that steeper terrain. And back in the 20s and 30s and 40s, when these massive numbers of wells were drilled, they would move truck rigs along roads, pull off the road, and drill. And they were able to do that because the terrain was amenable to that. Now, and in wells and leases I've drilled in the past, the type of terrain you see on the lease side of the river is no longer a challenge to us. We cut our own roads around the hills, through the hills, not literally through, but I mean all around, bounding the hills, and everywhere we need to be is no longer a problem. So that is.
So in the past, I mean, these hills would have been very difficult.
Yes.
But with today's bulldozers and with today's, we can easily get rigs on location without issues of being on a steep hill.
Certainly. And you see, actually, 2 wells have been drilled on the lease in the past, and we'll look at the information on those wells here in a minute to show you that they are every bit as favorable as wells that were drilled across the river. Okay, if you can go back up to page 3 for a minute, Sean.
Okay. Here we are.
Okay. Now, the wells you see mentioned as 16173, 16174, those are permit numbers. The first one was drilled on our lease, our current lease, in 1982, about 1,000 feet deep. The second one was drilled to 1,786 feet deep. This is important because the first shallower well was drilled just to where the old timers used to drill them. They hit the first 2 pay zones only. The second well found another 5 pay zones between 1,000 feet and 1,786 feet. Just that 786 feet extra gave them 5 additional pay zones. So it penetrated 7 target zones within the lease. Both wells have produced continuously for nearly 40 years, with them having been drilled in 1982. Now, if you go to page 14 for a second, we'll look at how thick the pay zones were in those wells.
Page 14?
Yes, sir.
Okay. So we're going to look at
just a chart that shows thickness of sands.
Regarding those 2 wells. Okay.
Yes, sir. And others besides.
Okay.
There you go. Now, If you look at the numbers in the middle of the chart, 16173, 16174, down
Hold
toward
on,
the
let
middle.
me find that here.
There you
Okay,
go.
so
You'll see that the first well, 16173, penetrated the Penny Zone, the Fulmer Valley Zone, and the Kane Zone. It did not drill any deeper, and it did not log the Bradford, which is also a pay zone. So they were looking at traditional Penny and Fulmer Valley oil pay zones here. The Kane Zone is a sand formation that bears gas. They penetrated it, but did not produce from it because there were no pipelines available in the area at that time. Now, if you look at the one just below it, the Exchange Oil and Gas number 14, which was also drilled in our current lease area, these are net pay figures for the sands they found. If you add up 10, 16, 8, 32, 12, 50, and 14, you'll see you have a number that exceeds 100 feet of net pay sand in that one well that was drilled down to less than 1,800 feet. Now, we will look at a couple of the logs in the area so you can actually see the log having passed through these pay sands and the indication of oil and gas that they gave. If you go back up to page 4 again, please, Sean.
okay. Page 4.
Yes, sir, page 4. Expected productive values or production volumes. Pictures are nice, history is nice, but people want to see what wells in the area have done, or at least they want to know that the wells are capable of returning their investments. State production reporting was not required in New York until almost 1980. So the only people who knew how much oil was being produced were the producer and generally the refiner who purchased the oil from the leases. Also, these wells generally will produce 10 or more wells into one tank or one tank battery. So you don't really know exactly how much oil one particular well is making, but you can take averages for a number of wells and arrive at figures that make sense economically, and you know why people continue drilling out here. Now, if we go down to the page 10 table, this actually gives a operator's report for how much oil was produced. I'm sorry, page 11. Sorry. There you go. Now, this is an operator's annual production report from a dozen particular wells in the area. Now, we don't know how old each of these wells were at the time, but we do see what the 12 of them produced over a year's time. And if you scroll down just to the bottom of this page right here, Sean, this was a report that was legally binding by the operator. In other words, he was saying, yes, this is how much gas and oil we really produced out of these wells. You'll see just above, in this particular year, from these 12 wells, produced only from the shallowest zone in the wells, which is a Fulmer Valley. He produced 20,000 plus barrels to the pipeline and sold almost 61,000 MCF from these 12 wells. Now, please scroll down to the next page. Page 12. Okay, now this is a map of the wells that were reported on that chart above. You see the gold box, that's the location of our project. And when you see the producing wells around, some are older, some are newer, but the average of those, if you pull down a little bit farther to the green box below the illustration here, the average production for that 1 year per well was 1,680 barrels in 5,000 MCF. At current prices, at $100 a barrel, you see that would be 1,680 times 100, which would be $168,000 for the oil and about $20,000 per the gas for each well on average.
So you're saying that each well on average produced about 180,000 gross in energy?
About 168,000. Yeah, that's right. 180,000 gross when you add the oil and gas together at today's prices.
So if you're drilling $165,000 well and you get back 180,000 gross in 1 year, that's pretty good, right?
Well, it is. And bear in mind, these wells were drilled with different and inefficient fracks in probably the 60s and 70s. Different from how we do it now. And only one zone was exploited for these wells, as it says in the report, the Fulmer Valley, which is the shallow oil sand that they found above 1,000 feet.
Yeah, so this is very exciting. I mean, they completed out of one zone.
Yep.
With draconian technology. They didn't even have fracks back then. I think they used dynamite, which destroys the structure. And the longevity of the structure isn't there. You destroy the structure.
You don't frack out very far with dynamite. No.
Yeah. So we're tapping into 6 or 7 zones with today's tech. I can imagine that's what it really excited me about this prospectus. So go ahead, Kevin, keep going.
Okay. That's the point I wanted to make here, was that we are not pioneers in this particular area. There have been literally thousands of wells drilled within 20 miles of here, and within 2 or 3 miles of here, there have been literally hundreds of wells drilled. If you look back at page 7 again, the main map for our project region, the point to be made is that this is a state map from the New York Oil and Gas Association, and you can Google it and see the same map I used here. But if you look at the legend on the left, you see green dots are oil wells. Blue dots are other wells, generally oil and gas wells. And dry holes are shown by either an empty white star, or a black star. And if you count the number of black stars out here versus the blue dots or the green dots, you'll see why it's a traditional 1% or less dry hole rate. Now, the wells that are the red stars that look kind of like the dry holes are actually not. Those are gas wells only. But the only dry holes in this area are the black and the hollow stars. And you don't see many hollows. You see one over there on Irish Hill, just to the east of our project. But and a few over to the southeast. But these are very much the exception. And some of them were drilled a long time ago and were plugged before they even reached the very first sand, because it was difficult to drill even 1,000 feet deep until the 1915, 20, 25 year, when you could take them down a little bit deeper. But a lot of guys just gave up early on the early projects. But
so with today's tech, a lot of those dry holes, what you're saying is a lot of those dry holes wouldn't have been a dry hole. They would have drilled deep enough to hit and encounter the structure.
That's correct. Even in the far right there, where you see those 5 dry holes together, you see four gas wells just north of there, to the far right of the map. And generally out here, if you have a dry hole, it's because you had mechanical issues. Because these are what our formations are, what are called blanket sand formations. They exist throughout the area. They were deposited in the shallow sea in Devonian times about 400 million years ago, and are simply layers of sand buried by layers of shale over the eons. The oil is derived from the shale, collects in the sand, and it was left there for us to exploit the sands between the shales. And the oil is generally present in every single sand below about 350 feet down to about 5,000 feet. But the deeper you go, the bigger your frac has to be. And we want to keep these manageable and within state regulatory requirements.
Good deal.
Okay, I guess we can go back to page 5 here real quickly, and we'll flip down and see if we have anything to talk about that's particularly enticing. Yes, okay, what we're looking at is log analysis results from Mr. Van Tyne. He actually was participating in many of these wells that were drilled in the 60s, 70s, and early 80s, and made estimations as to what the wells could produce if every zone were exploited in each well. Now, he pulled such numbers as one particular sand, the Cane sand, mentioned here in this top analysis, containing 19,000 barrels of oil per acre. That's for one sand alone in this area. Now, you're only going to be able to economically produce about 10% of that, but still 1,900 barrels per acre over 5 acres is almost 10,000 barrels producible, he predicted, from this one sand alone, the Cane sand. Now, he made other projections for producibility from all these sands below these traditional Penny and Fulmer Valley sands, and felt favorably enough about this project that he recommended and purchased the lease for his own family. Steve Ford, who owns Vertical Drilling, is Mr. Van Tyne's son-in-law. So this is essentially a family inheritance that is now about to be fully exploited. Okay, if we will skip down just a little bit, we mentioned rather, the Penny and Cane sands as being shallower sands. Now the Wiskoy and Nunda, these are gas and condensate sands that are very thick, well-developed, and will be encountered about 1,800 feet in these wells. Okay, we can skip on down to the next page, please. Okay, Mr. Van Tyne summarized an estimation of 3,000 barrels from some of the shallow sands may be possible. Now, these are quotes from his report. Now, some of the shallow sands, we have to assume he's talking about sands above 1,000 feet. And this is a very, very strong recovery. Even at 10% recovery, he is saying that they could produce 3,000 barrels per acre. That is possible. We won't know it until we drill them. But my wells that I drilled,
he's basing the 3,000 barrels per acre based upon 2 zones, correct?
That's correct. Yeah, the traditional.
And we have the potential to encounter 6 to 7 zones.
Yes, we do indeed. But the shallower zones are mostly pure oil. As you get deeper, the zones begin to bear more gas, which is fine too, because we can sell it at a premium price. The gas is high quality. The oil at 42 gravity is some of the best in the United States. Now, these are just deal economics right here that we already discussed about payouts at certain product prices. But we can look at those later on in the spreadsheet. If you could pull down past page 7, go to page 8, please. Now, this is showing you the great number of oil and gas wells that have actually been drilled in Southwest New York. It's just a continuation of the Pennsylvania shallow oil trend that began in the 1850s. It got into New York in the 1880s. And there are still many, many wells being drilled every year, and even as we speak, in New York State. Okay, now if you will go, please, to page 10. But this is a Steuben County well that produced from one shallow sand only. It's called the Allegheny Energy's Lomac number 2. This well is, a few miles from the project. I don't have it marked on the maps, but it made in 8 years, over 5,000 barrels of oil. Now, they didn't measure the gas, although it was certainly made with this oil, because rather than produce water with our oil, we produce gas with our oil. That's the motive force for this oil. So everywhere you have an oil well out here, you will always produce gas. If you'll move up just a little bit again, please, Sean, to that green.
So let me ask you this. So
yeah.
That well,
yep.
Out of which zone?
That was out of the Fulmer Valley.
Okay. So why would producing 5,200 barrels of oil in 8 years be exciting?
Because that represents that $100 oil, that's $500,000 worth of oil, or in excess of that. Plus, you probably produced an additional $150,000 worth of gas on top of that over that period of time.
So in 8 years, one zone produced roughly $650,000 worth of energy.
That's correct. Yeah.
Okay.
Yeah.
That's exciting.
That produced from the cane sand, as I showed down there.
Okay.
So I correct myself. It did not produce from the shallowest zone, but it produced from the cane sand, which is one of the zones that you find just below the Fulmer Valley.
Understood.
And we have that actually in abundance on the lease. Okay, next page down.
Okay.
And we already talked about this as being a certified producer's report, a snapshot in time of the production from 12 wells in the immediate area of our lease. Some wells were newer, some wells were older, all were productive. Okay.
So this, okay. So what are we looking at here? So out of 12 wells in 1 year produced 20,000 barrels of oil?
Yes, sir. And 61,000 MCF of gas.
Okay. So we're talking about how much oil is that? 20,000 barrels of oil times $100 oil would be 2 million?
2 million. Yeah.
Yeah. So $2 million worth of energy. That's an average of $180,000 per well.
Yes, with the oil and gas combined. That's correct. Over that 1 year period.
Yeah. So
some of these wells are weak, some are strong, but it's nice to have an average of older and younger wells shown on the same chart.
Yeah. So to have 12 wells average $180,000 gross of energy, and out of just the Fulmer Valley zone
in 1 year.
And we're drilling these wells for 165,000. We've got potential to encounter 7 zones. So,
that's
all right,
correct.
Keep going.
Okay. Why don't you go ahead and slide over to page 15, which is actually the first chart, the first graph of an oil log. Okay. Yeah, good. This is a well just to the southwest of our lease. I marked obvious pay sands in pink. The graph on the left shows presence of sand. The lines on the right will kick out to the right when there is hydrocarbon present. And the one farthest to the right, on the far right part of the chart, will show absolute presence of hydrocarbons by the intersection of the curve that comes from the left and the curve that comes from the right touching. So you see we have one pay zone up there as shallow as 660 feet, 650 feet. Now drop down a little bit farther, you have another pay zone from about 704 to about 720 feet. Okay, keep pulling down. You have a third pay zone. This is the penny sand, one of the traditional sands in the area, 770 feet deep and approximately 27 feet of net pay containing oil and gas. Okay, slide down to the next page, please, on page 16.
Okay.
Okay, this is the Fulmer Valley sand. You've got about 10 feet of net pay here, oil, apparently. And pull down to the next page, page 17, and we're still in one well.
So next page.
Yes, sir, next page.
Okay.
On page 17, we are looking at the cane sand, which has looks like between 40 and 50 feet of pay sand in it. And you can see the strong crossover on the right, those shaded areas that show absolute presence of hydrocarbons.
And if you want to learn more about logs, we have a video on the YouTube channel where Kevin goes into more detail regarding a log.
And we're not done yet. Go ahead and go to page 18, and we're still in the same well.
Okay.
At the bottom of page 18, you have.
Hold on here. Okay.
You have the first of our good gas sands, the Wiscoy sand. It bears gas from top to bottom over an interval of approximately 70 feet thickness. That's quite an amazing gas sand. Some parts of this sand are better than others, but all are productive of gas and oil. And then finally, one more sand in this well. Go ahead and go to page 19, please.
That's the next page?
Yeah,
Okay.
Next page. Here is another gas sand, the lower Wiskoy, in this same well. And once again, you have about 70 feet of net pay. Look at the shading on the right, the shaded area. And
Okay.
that is absolute presence of hydrocarbons indicated there. Final sand on the next page has a little more pay to add to this well.
Okay.
Okay, that is the Nunda sand, the lowest sand that we will be exploiting in this project. And we're looking really at about probably 10 to 15 feet of pay in this particular sand. But altogether, in this well alone, you're looking at between 150 and 200 feet, net feet of pay sand encountered by the time you reach 1,800 feet depth. It's quite exceptional for the industry.
Excellent. Can we reference the well location? One more.
Yes,
what page
page
is that
7.
on?
Now, this well is the one off to the southwest, East Resources, Crowder Creek, number 7.
Okay, so this well was the log that we were looking at.
Right, and you're about a mile away from the lease, and this is the well that we just looked at that has 150 to 200 feet of net pay in it.
Excellent.
Now we will look at, we're not going to go through logs all day here, but let's look at the next log, the only other log we need to flip through at this time.
What page is that?
That is below where you just looked and would be on page 20.
Okay.
Let me see, log B, page 21.
Okay, I'm there.
Okay. This is a more modern well that was drilled in 1982. And this is just the title of it. It's, as you can see, it's well number 16173. You can see the pencil writing down there on the right. And this well was drilled in 1982.
We're just going to trust what you're saying here because it's. Oh, which are we talking about? The top portion of this thing or the bottom portion?
All I'm trying to say is this is the title of the well and the title of the log, but you can pull down to the next page, please.
Okay. All right, go to the next page.
Yes. This well was actually drilled within the confines of our lease in 1982.
Mm-hmm.
Now pull down a little bit farther. This
is a well on the lease.
On the lease, yes.
Okay.
And it was drilled only to the traditionally productive areas. There's the penny sand. And you might recall that's the shallowest sand out here, about 630 to 650. And now drop down to the next page. The Fulmer Valley sand. Okay, now this sand appears to be nearly 100 feet thick.
Okay.
This well was not run with those logs that we had crossover showing on. This is strictly a basic log, but you see the curve on the right kicks out to the right from the top to about the bottom 2/3 of the sand, and that represents the presence of oil and gas from this, which this well produced. Now pull down to the next page if you would. This is log analysis done by the logging company for the oil company that drilled the well. It shows in that top sand, the penny sand, that oil was seen in the sand from 645 all the way down to 670. So that's 25 feet of pay. The analyst at the time marked high oil. He marked good porosity on here. Go ahead and scroll down a little bit farther, Sean, and we can see some more of the results that the geologist wrote. High and good, that's average oil saturation, 51%. That's a very rich reservoir. And penny sand in Fulmer Valley, he was trying to add up producible values out there. It says 31,000 some odd. Take 10% of that. That's what he was expecting from the two sands in this well. Now, 31,000 barrels divided by 10 is 3,100 barrels, and for plus the gas that he would have made. And for a well drilled only to, go ahead and pull it down to the next page, please. A well that was only drilled to 900 feet, that's a very good return on investment. This well, from our determination, made over 3,000 barrels and over 40,000 MCF. We do not have the original production report for this well because it was not tracked at the time. But the well is still on the lease and was producing oil and gas up until the COVID pandemic of 2 years ago, at which time it was temporarily turned off. But this well still does exist and is 40 years old and is on the lease. It's very similar to the logs we see on the north side of the river, and we're seeing production that is favorably comparable to those because it was drilled to the traditional 2 shallow zones only. So this well more than paid out and did not exploit the reservoirs that we are looking to drill to. It only exploited the top 2 oil zones and left it at that. Okay, let's see. I think we could go through more well logs in here, but the point is the same sands producing on the north side of the river are everywhere present on our lease as well, because we have log data surrounding the lease that shows the presence of the sands and the indication of hydrocarbons. Now, the last thing we want to show is page 27, which is the drill spacing survey map. Okay, there you were. Either one of those will work fine. But as you recognize this, the Z-shaped lease that we showed you on the master map, but this is the original plat that was filed with the state for the eventual exploitation of this lease. It shows 50 drilling locations. Each are about 350 to 400 feet apart. And because no wells have been drilled in this lease except for the 2 that have circles around them, to the left of Sean's name there, you'll see 2 wells sites that have been circled. Those were the only 2 locations that have been drilled here. We have room for 50 more. We know from those wells having been drilled that we have sands all the way down to 1,800 feet that are hydrocarbon bearing. And we're going to go after all of them. And we'll drill each of those wells and complete them at about the rate of 1 per week, sometimes even faster, because we'll have a drilling rig and then a completion rig move in right behind it. So the project is already laid out. The sands are present within the lease and around the lease. Production is present in all directions from us. The dry hole rate is 1% in the area, and oil prices are about as good as I've ever seen them. At the end of the booklet, you'll see spreadsheets that project what a typical well and the entire project will do at $85 oil and at $100 oil. And I would encourage anyone to look at those spreadsheets and draw their own conclusions. They're very easy to understand. First revenue disbursement will come within 30 days of completing the first well. And then we will have increasing revenue as each of the wells are drilled. We're looking for 8 wells the first month and 7 wells to follow until we reach 50 wells, which we expect will take probably 5 or 6 months to drill those wells. But revenue will start pretty quickly after drilling the first well, because we flow back the frac approximately 6 days after drilling the well, which takes about 2 days to drill. So it won't be much gap between spudding the well, touching the drill bit to the ground, and producing from that well bore. Very, very favorable rate of first revenue, and we think a favorable return on investment over a reasonable period of time. I would encourage you to look through the prospectus in detail. My phone number and email are listed on the second page of the prospectus, and I encourage anyone who cares to give me a call, and I'll answer any questions you might have.
Excellent. Well, listen, Kevin, I really appreciate your time today. And of course, we have to cover our butts. There's no guarantee in the oil and gas industry. And the only thing I could guarantee is death and taxes. And so every investment in the world, there's no guarantee, obviously. But, the less than 1% chance of dry hole. And based on, less than current oil prices, actually oil price is $106 a barrel. It's a very conservative 15-month payout. And I told Stephen, I was like, hey, let's bump up these numbers because based on wells in the 70s and 80s, they're doing better than this. And so Kevin's name is on the line here. He's an experienced geologist. He has no interest in muddying his name for any oil deal. And so I really respect that about these guys. But veteran oil and gas guys, they don't want to see the fluff. They want to see real data. This is a real oil man's deal. And it's a really good new guy project, quite simply, because of the risk factor in this thing. I mean, it's very low risk. So Kevin, I really appreciate your time on this thing. If you guys are interested in looking at this deal, please get in touch with me. If you want to set up a conference call between me and Kevin, you want to come out to the field, great. But please subscribe to this channel and please like this video and please comment if you have any questions. And until next time, we'll talk soon. Thanks, Kevin.
Thank you, Sean.